Good morning. John Davis here. Hope everyone is in good health and good spirits. These are challenging times of uncertainty, confusion, and in some cases fear. So we wanted to do all we could to keep you informed, and as a result, we organized this Dixon Mitchell webinar. We thought it would be a good idea in light of the unprecedented events surrounding COVID-19 and the capital markets to give you an opportunity to hear directly from your portfolio manager. So we're fortunate to have Jim Katsouleris join us. Many of you know Jim. He manages the Calgary office of Dixon Mitchell and sits on their investment committee that provides direction on about the $2.4 billion of client assets that they manage. Jim grew up in Toronto, but we won't hold that against him. And when he's not busy, being a steward of your hard-earned money, he's coaching his young kids' sports. But considering there are no kids' sports right now, we're grateful he has lots of time to manage your money. Before we get going, we have a few housekeeping items to cover. This is our first webinar, and we wanted to get this information to you quickly, so please be patient if we run into any technology glitches. Secondly, during the presentation, feel free to ask questions. All attendees' microphones have been muted to cut down on background noise. So in order to ask a question, please use the chat box that's provided in the upper right-hand corner. There's an icon that says Q&A. We will have one of the Blackburn Davis financial team bring these questions forward to Jim. If you're not able to ask your question, or if you think of something afterwards, of course, Jim will be available offline via phone or email. There should be an icon of a microphone underneath each speaker. So please make sure it's unmuted or you won't be able to hear Jim or the other presenters. As this is a first time for us, any feedback is greatly appreciated. Even well after our social distancing requirements have passed, we may continue with this sort of event if it's well received and if you find value in it. So please forward any comments you may have to us. Jim, are you ready to start?
Yeah, definitely. Okay. Well, thanks for John, Stephen, Kelly, and Cindy. Thanks for setting up the call. Thanks for everyone for taking time in your day. I just want to highlight just a summary of our discussion. I just want to articulate, where we are in the economy, and more importantly, what Dixon Mitchell is doing behind the scenes and in positioning your assets. And like John said, these are definitely unforeseen times. I think the last occurrence was 100 years ago in 1918 with the Spanish flu. But anyways, hopefully, like I said, I think there's a lot of negative news in the press. Just turn on CNN and Fox. I sort of tune that out. I don't watch that anymore. But there are some positive things happening, which I'll highlight. Just to start off, just our approach. I just want to highlight how we manage money. And our philosophy is the following: we invest in businesses capable of generating sustainable cash flow and operate by a competent management team. So we don't speculate. There's no Bitcoin in your portfolio, never was. No marijuana stocks in here. And I think that's what we're really trying to highlight is I think the number one variable we look for in companies is management teams. I think where we've evolved in the firm in the last 10 years, we were more of a dividend shop, which are very important, but we're also looking at companies that may pay lower dividends, but they use their cash flow to grow their firm. So right now, just the fourth point here, economic commodity interest rate cycles, they're obviously impossible to predict. We don't know where this is going to end. I was reading an article from Howard Marks, a well-known money manager. He even said, we've never been in times like this, so how do we know where we're going to come out? But like I said, I'll talk about what management teams are doing behind the scenes to protect your assets. So everything we know now is driven by top-down fear. What we saw, when we talk collectively, like I was talking to Ken, our CIO, and we just had a discussion. We talk almost every day, but we talked about last week, and it felt like 3 months ago because so much is happening. This market downturn is the swiftest it's ever occurred in 100 years. So like 2008-9, this requires us to be more deeply consider macro conditions, because we're trying to get a feel. A lot of the questions we're asking, is what is this business going to look like when we come back? And that's where a lot of our time is trying to gauge, what companies are going to look like and what the economy is going to look like. So here's some positive news. Collectively, we sat down with the group and put together, obviously I've been in the business now for 22 years, and sort of, the only positive of 2008-9 is it serves as a playbook today. So here are some positives. So as you recall, in 2008-9, when we got into that crisis, a lot of it was because of poor lending. Financial institutions had terrible balance sheets. Where today, banks are well capitalized and have strong balance sheets. And just to give you an idea, when we look at it, banks today have 3 times more capital buffer than 2008-9. Point number 2, banks are working with clients and companies. As you recall, in 08, financial institutions were just trying to survive. So if Jim or Steven defaulted, didn't pay their mortgage payment, they would be knocking on your door saying, we need this money, we'll take your home because we need the capital to survive. Where it's different today, banks are, like I said, working with clients where they're deferring mortgage payments up to 6 months. They're reducing interest rates for credit cards. And point B, access to capital for companies. So a lot of the time we're spending is we're sitting down with the management teams and we're asking him or her going, okay, you have a good balance sheet, check, but do you have access to capital? Because as you know, during this time, the revenues have dried up. And surprisingly, what we've heard from CFOs of these companies, they've said banks have been great partners with us. And in some circumstances, the banks have actually reached out to them saying, if you're looking for an acquisition, we're willing to help. That was unfounded 12 years ago. Point number 3, central banks are being proactive and aggressive. And I have a slide here showing that. So I've done a lot of reading on 2008, watched a lot of documentaries. The common criticism back then, central banks were late to the game, where today they've injected historical liquidity. So they've been proactive and aggressive. There's a quote by the Bank of Canada, Mr. Pelosi. It's a great quote. So 2 weeks ago, Friday, they reduced rates 3rd time in a month. And his quote is, a firefighter has never been criticizing for using too much water. And that's what you're seeing from all the central banks. Also, point B, banks now are going directly to consumers. So if you recall, in 2008, they had TARP funding or bailouts for the financial institutions where the dollar didn't reach the consumer who needed the money. That was the major criticism. Now this money is getting directly to consumers and small mid businesses. Also reducing rates to 0. We've seen that before. But one thing is it's unique in Canada. Quantitative easing, you may hear it in the news or in the paper. That's when the government buys bonds in the market to provide liquidity. This is the first time Canada has ever done that. In the US, they did that in 08. Canada, first time. Point 4, central banks are working together. I remember, if you've ever seen a movie, Too Big to Fail, it's one of my favorites. There's a part in the movie where Hank Paulson, they let Lehman Brothers default. And then he picked up the phone and called Miss Lassard of the Bank of England. And basically what she said was, how dare you do that without letting me know, because that has ramifications in Europe. Today, these institutions or the central banks are talking collectively. So those are huge pluses that we've learned from, during 2008-9. Okay. So this is a busy slide. I'm going to simplify it. What you can see here in the white line, this is the world GDP. Okay. Then in the dotted line, that was past world GDP. The dotted line is what analysts thought would occur prior to the crisis. Then in the blue line, when this occurred, this was a readjustment, what they thought will occur. And then the line that has a severe drop, that is what is currently happening now. Okay, so a common theme we're hearing from companies, we're providing no guidance because they just don't know when we'll get out of this, how severe it will be, and the time length. So just to sort of give you a guideline, you know, what's happened in the world economy. So where are we now? Obviously, this is. Oh, can you hear me? Can you, Stephen? Can you hear me?
Yes.
Okay, perfect.
Yeah.
Sorry, I had a phone call. This is my first time doing this too, so good. It didn't take that. This is a virus. I think the difference here, talking to clients, back in other crises, it was more human-made, like the technology bubble, the 2008 crisis. This is not human created. So, you know, this is not a contraction. This is basically a freeze, as you know from staying home. So in 2008-09, the financial system led to an economic plunge. This has led to a nosedive. So the difference, I mean, literally another difference, we could go for a cup of coffee, where now I'm talking from my office. And when I look outside the parking lot, if any of you have been here, there's literally 4 cars in the Park Plus, where it used to be jammed with 200-300 vehicles. Similarities, worry that things will never be the same. It's unprecedented. I do believe, I am an optimist, but I'm a realist. As Mark Twain's famous quote, history doesn't repeat itself, although it does rhyme. And, you know, you're seeing a lot of positives like Canada flattening the curve, South Korea, Taiwan, Iceland. You know, we will get past this, but obviously there are some tough times ahead. So this is just to highlight the U.S. unemployment. As you can see, you know, actually you can see my cursor here. Unemployment in the early 80s, 82, I believe, hit over 12%. Now this is just the infancy stage. We have not updated, and I'll show you a slide next. Unemployment, once this occurred, crept up to 4.5%, 5%. But this will give you a gauge. Unemployment reached 12%, like I said here, in 08-09, roughly 10%. And this is not a proper gauge, because one thing about unemployment numbers is when someone steps out of the workforce, they're not classified in those statistics. There's stats probably in 08-09, unemployment hit probably 16, 17%. But once again, when people dropped out of the workforce, they took away those numbers. So when you look at it here, so it's a busy slide, so bear with me here. On the bottom column here, you can see weeks since the crisis began. So in the black line, you can see the U.S. initial jobless. This is in 2008-09. So follow the black line. It's gradual. This crisis, unemployment skyrocketed to almost 3.5 million. And as of today, the crisis, it's roughly, the amount it hit is almost 16 million in the U.S. Okay, so obviously that literally has gone up vertical, and that's where we're standing today. Okay, so the monumental stimulus, when we look at it, remember, earlier in the presentation, I mentioned how in 08-09, the criticism was they were delayed. At the bottom horizontal axis, you can see these are the number of days since the crisis. So it took almost 200 days to add stimulus to the economy. They added it within immediately. So that's a plus. Also, this is already outdated. We put this together a week ago. With rate cuts, credit lending programs, it's expected the amount of capital injected from the federal government could hit $6 trillion in some capacity. So right now, as of this slide, it's roughly 2.25. It could hit roughly 6 trillion. So I think here, as I indicated, this is no one's fault, the virus. Long run, I mean, I think we got to sort of stay invested, and have a couple slides highlighting that. So when we look at it here, what's the most important question? Obviously, it's not will the economy and corporate earnings be bad? We already know they're obviously depressed. But will the economy and earnings be worse than what the markets have priced in? And that's what we're trying to quantify within our companies. Because at the end of the day, when we value a company, it's the present value of future cash flows. So, and there's a slide I have where we've added to new names and added to additional names where we got to look 2, 3, 5 years out. So we know the next 12, 18 months, cash flows and earnings will be depressed, but we got to look past that. So in this scenario, health progress, much more important than the economic earnings figure. And that's what we're really trying to gauge the companies is, are your balance sheets good? Maturities coming due, can you roll the debt? And as I mentioned before, stocks are forward looking. So when we got together, the investment team in March 9th, 2009, that was the bottom of the market. News for the next year was negative, but the market saw, hey, this is the worst news. So really, like I said, you really got to look past this and think to yourself, hey, in the next 12, 18 months, things are going to improve. And some companies are being priced as if the economy is not going to be normal for 3-4 years, which I don't think that's the case. So here I just want to, this is a busy slide. Let's just focus on the top lines. The top lines is the China subway ridership. We like to use GDP, but unfortunately, the numbers you get from China may not be transparent. So one metric people look at is subway ridership, and where it dips down, that's on weekends. So you can see where it starts off. That's after Chinese New Year's, where things in China really ground to a halt. Obviously, everyone's home and celebrating. But you can see in 2008-9, there's been a gradual increase over time. Here in the orange line, you can see the activity decrease, but it's slowly coming out. So like I said, that's a positive. I mean, China was ground zero of the virus, and they've taken measures and whatnot. So people are starting to go out. If you read one of our prior newsletters a few weeks ago, one thing we've seen is they're starting to open stores. So Starbucks and Apple are reopening. And someone said, well, do they have to? And I said, one thing we sort of figured, we know the CEOs of these companies wouldn't put their clients and most importantly, their employees at harm's way. So that's definitely a positive. Okay. So as we know, market bottoms are not easy. One thing you can see here, the first market bottom was down 27, because I get this a lot. Jim, is it a good time to put in new money? And I said, if you don't need this money for the next, excuse me, 5 to 10 years, it's definitely a good time. Just one moment. So we look at here, we had a double bottom. The market went up 27%, and then it reversed down to 666, and then it fell again. So that's what. So as I said, the key thing here is we don't know where the bottom. Could we have hit the bottom? I hope. Do I think so? No. Could we retest it? Definitely, because as news comes out, I think the point here, and I'm sure John's and Stephen's office and Kelly, you can't time it. And if you're putting capital in, what we're saying is if you don't need the money for 3-5 years, then hey, you're buying things at 20-30% discount. If you need it within the next 2 years, then I would probably argue maybe not wise to dump in additional funds. Okay. So in the long run, when we look at it, whether you bought in November of 08, which was the first dip that I showed you, or March 9th of 2009, or January of 09, it made little difference. So question is, are we in this box? I'm not saying we're going to have a bull market like we did. Like, you just don't know. But point being here is people that try to time the market and missed out, you missed out in probably one of the best markets. And this isn't just 08, 09. You go through every crisis, like the tech crash. the 1987 crash, the early 80s with high interest rates. You just can't time it. Okay. So how has Dixon Mitchell responded within your portfolios? I think the key thing here, let me just articulate how we manage bonds. Bonds, in our view, is there for stability and moderate income. We take risk on the equity side. Prior to Dixon Mitchell, I worked at another firm similar to our firm. And I remember during that crisis when they had high quality bonds, I learned a great deal. There's no substitution to bonds. If you want something higher returns, you have to take on greater risk. So one thing I've seen is some clients reach out for yield and buy mortgage type products, even in some case preferreds and whatnot. And one thing we've seen is our bonds are relatively flat this year, if not up roughly 1%. And over the past 2 years, what we've done is we've increased the credit quality of our bonds. What I mean by that is we sold some of our BBB bonds, and today 100% of your portfolio is in single A, double A, triple A. And the reason being is we felt you weren't being compensated for equity for credit risk. So why own those bonds? So they've held up tremendously well. So one thing we've seen is rates have dropped. This is the lowest the 10-year government bonds ever been, 0.63%. And as I mentioned before, we've reduced the decline. Most balanced portfolios, give or take on the asset mix, will be, give or take 10% in Q1 when you get your reports. As I mentioned, enhanced credit quality. We did not chase return. And also we reduced our corporate allocation bonds, which now stands at 20%. And a few weeks ago, we sold some bonds because equities dropped. So your asset, for example, if your asset mix was 30 bonds and equities dropped, your bonds went to 36. So we took this opportunity, we sold some of our bonds and we purchased equities at lower valuations. Okay. So one other comment I want to highlight, I get this question, bonds aren't making much now, Jim, going forward. What should I do? If some of you were with us in 2010, during that time frame when spreads blew out, and what I mean by that, let's say for argument's sake, there's a Canada bond paying 2 and a TELUS bond paying 3%. Let's assume TELUS bond, the spread goes to 5%. That's what I mean by spread. So, the spread before was 1%, 3 minus 2. Now it went from 2 to 5. In 2010, we used that opportunity where we increased corporate bonds to 60%. So we can be tactical with bonds. So like I said, the mindset's always been, I'm not going to make much on bonds. If we see spreads blow out, there's some great companies out there where they may have to pay higher rates. We can and we will go out the risk curve if they compensate us. We're not doing that today, but we're being mindful because there are some great opportunities presenting themselves. Okay. On the equity side, the first metric we look at is survival. And those are the discussions we've had with management teams. I'm sort of repeating myself, but emphasizing, is your balance sheet fine? Check. Do you have credit facilities? Check. Your accounts receivables, debt maturing. So that is the number one thing we're looking at. Our companies are survival rates. So we put all the stocks through rigorous reevaluation, examine liquidity, solvency, short-term outlook, estimated the max loss scenarios, and numerous management interviews to gain intel not in the numbers. And I'll give you a couple examples of a couple, just highlights of discussions we've had. So as a result, we have liquidated names facing structural challenges. We eliminated virtually all energy holdings. And I know being in Alberta, we do have some energy, but it's minor. They go, why are you selling it? And the reason being is there is no visibility. So obviously, as you know, COVID, 1, 2, the price war with Saudi Arabia and Russia, and then 3, the Trudeau government, no pipeline. So even though we want to increase weight, there's just no visibility. And for us, there's other names that have dropped in value, but a great deal that we can add to where we feel there's upside. And obviously, we've rotated money back into stronger positions. So here's an example. This is a few, and you don't have this. I have another sheet of paper. I'll just articulate. You can see here. But this is what we've done to take advantage of weakness. We added to Methanex. We sold it a year and a half ago at $80. We bought it. Obviously, unfortunately, it's come off again. We bought more. We took this opportunity of weakness to add to Dollarama. We owned Dollarama a long time ago. Just got expensive. We had a call with their management team. The stock came off. We liked the business. It's actually held up very well. So we initiated a 2% position. We reduced TELUS and Canadian Pacific. The reason being is they held up pretty well. So we felt we had other companies that had more upside. And then we sold Cineplex, I think at $33 when they were being takeout. Finning, Prairie Sky, CI, and Suncor. So another few names, I don't want to add a whole bunch of names. There's been a lot of volatility. We've actually added names to some companies that were small positions. Example, Brookfield Asset Management, which is now a 5-weight. Brookfield Infrastructure, Enbridge, TD, CCNL, Gildan. So there's a number of names that you don't see on this page that we've increased their positions because the stocks have come off. Okay. I want to be mindful here. I know we started a little late. It's 11:28. I will take time, and I'm not going to rush it, but I want to be sure that I respect your time. And if people have to leave afterwards, if you stay afterwards, I'm more than happy to address questions. As I say, I got nowhere to go. So, so how is Dixon Mitchell doing? End of the day, here's a proxy. We manage a fund called the VPI Canadian Balance Fund. This is as of Q1, March 31st. And this is just to get a gauge how we've done. I think the number one thing, when I was talking to Ken, our CIO, we don't talk enough about our firm. I gave our team a lot of credit, is our bonds. We didn't stray from our policy. As I said, some managers did where they try to chase return, maybe deviated from their philosophy. I don't know. I'm not being critical. I don't like talking to other managers, but we stayed with our, within our policy guidelines, and this has helped the portfolio protect, a great deal. So that's just a high level. So dealing with the new paradigm today, you're thinking like a banker. As you know, when you go and get a business loan or mortgage, all the bank cares about, will you pay me? And if you don't, do you have collateral to pay me? We're doing the same thing with companies now. Balance sheets are more important than income statements today, because income statements now, revenue in some companies are down 30, 40, 50, 60, even 80, 90%. Focus holdings, market recovery. We're trying to gauge when we put together portfolios, we sort of listed our companies COVID related and COVID not so much related, because we want to make sure we balance. If there's a recovery, some of these names that have been impacted, you still get upside within your portfolio. An example would be MT. Let's use Badger Daylighting. They make hydraulics, whatnot. I just spoke to Sorab, our lead manager. He had a call with them. One thing that Badger realized, first of all, they have the balance sheet to survive, but he got off the call with their CEO. He said two or three of our competitors that were smaller players, they're not, unfortunately, going to make it through this downturn. So they're going to pick up their clients without having to buy them. So they just increased their market share by 1.6%. And that's what we're seeing with some of our companies is, one, you can survive. Two, you cut your costs, your margins improve, and then when we come out of this, it just hits the bottom line. And three, you buy your competitor. And four, some of your competitors go bankrupt and you gain market share. So we're trying to avoid sectors that will be fighting the headwinds. So I think the key thing here, I mentioned it earlier, I don't know what's going to happen next 12, 18 months. You really got it. We're looking, when we're buying these businesses, will they be bigger, more profitable in the next 12 to 18, in the next 2, 3, 5 years? Market transition, as we mentioned, some industries are going to face headwinds: travel, energy, retailers, restaurants. As will companies that took on significant debt expecting stable income. So we never owned any REITs in our portfolio. We felt we weren't being compensated. And you're seeing, unfortunately, a lot of them being hit hard. Real estate, they took on excessive debt, and maybe they just thought, hey, the economy is always going to go, But let's be fair to them. This is a 100-year event. I mean, even in my wildest dreams, you couldn't factor this in your analysis. So as I mentioned before, the strong will get stronger. And I think here, another example would be we own Saputo cheese or Saputo in your portfolios. Here's a company that has minimal debt. They're a market leader. And I read an article last week. The CEO of the company said, hey, we're going shopping in the US. Some of those companies or competitors are down 30, 40, 70%. So this is the advantage of having good balance sheets. In good times, who cares? Because everyone's doing well. It's when unforeseen events like this occur, and companies like Saputo, in the eye of the storm, comes out and says, we're making an acquisition. And we have a number of companies like that are looking for acquisitions right now. Last point here, big tech firms, we own Apple, Microsoft's done well. They've benefited. And there's this, we have a lot of firms in our portfolio, like Berkshire Hathaway. They have $130 billion in cash. I haven't seen anything in the press yet, but I'm sure Warren Buffett and his team are eagerly reviewing companies to add to their portfolio. So the summary here, the economic standstill we're experiencing is like nothing in modern history. Several companies, industries will not survive. Those which will prosper have entered the crisis with strong balance sheets, provide goods and services that fit the new landscape, and be running and forward thinking. And the key thing was strong management teams. So I guess a few points I would leave with this call is worry less about the near-term earnings, even in your own portfolio. I know it's tough. We'll respond to what is. Markets think about what will become. Stocks will improve much sooner the economy. And as I mentioned before in 08-09, the bottom of the market occurred 12 to 18 months after all the negative news. So hopefully this is, hopefully it's the case. Keep our fingers crossed. But at least just a few things I want to leave here is, our money's invested alongside with yours. Company policy is all my personal assets. I don't have a side account that I trade on. All my net worth is tied to Dixon Mitchell. They don't give me shares. I have to borrow. So we're aligned with our clients. I had a really good question from a client the other day. We always talk about the portfolio, but how is Dixon Mitchell doing as a whole? I give credit to my colleague, Nick. We set up a continuity program over 12, 18 months ago. So 3 weeks ago, I believe, I forget the day, but we worked from home and everyone was already set up with laptops. The trading team didn't miss a beat, the portfolio management team, the client service. So that happened. Dixon Mitchell, we have no debt in our balance sheet. We have a lot of cash. And I think, we've had a lot of chats with Rob Mitchell, our founder, and it's nice to go to our employees saying, hey, they're the most important people in our firm, is saying, hey, your job's safe, let alone there's no pay cuts. And coincidentally, we just hired a senior person this week. I started on Monday in Vancouver, which will probably be odd for him, but just want to give you a high level, how Dixon Mitchell's faring.
Hey, Jim, thanks. Appreciate your time today. For everyone that might not know, my name is Stephen McDonald. I'm with Blackburn Davis Financial, and I just want to queue up a couple questions for you if you have some time.
Yeah, definitely.
So, Jim, one of the questions we received is this: looking forward to the U.S. election, your assessment is appreciated regarding the disruption caused by COVID and the potential for ensuing unrest or the impact. How would Dixon Mitchell sort of view the U.S. election and in all of this? And if you can make a couple comments, that would be appreciated.
Yeah, that's a good question. And I'll try and be very simple. And one thing about our firm, we don't make any big macro calls on elections. Obviously, it's going to have an impact. So let me start with this. Part of our policy guidelines is, you never see it in our literature, we have to be invested in minimum of 7 industries. We're actually invested in 8 because if something unforeseen happens, it'll affect one sector versus another. So we're always diversified just for political events, market events like this, war, you name it. Regarding that, I mean, to be frank, I'm 0 for 3 voting politics. When Trudeau first got in, I didn't think he'd get in. He won. When Notley got in, she won majority. And when Trump got in, I didn't think he would win. So I'll give myself credit. I did, Kenny, I was right on that one. So I'm 1 on 4. So answer your question, I'm being vague here because there's a lot of uncertainties what will happen. We don't put a lot of value who's going in. Like, don't get me wrong, if Bernie Sanders got in, it changes everything. He's more socialist. Where Biden, I mean, I'm sure he's not going to rock the boat. There's a lot of unforeseen circumstances, and with his agenda items, this is just our, opinion is I don't think he's going to make drastic changes to it because the COVID itself is a beast of its own. So going in there, I don't think, like I said, we haven't really heard his agenda yet because he just got nominated. Literally, Bernie Sanders just stepped out last week. But right now, I really can't comment. I'll be guessing if I did.
Okay, that makes sense. I have one other question for you, Jim. So given it's difficult to navigate these markets and whatnot, what does Dixon Mitchell think of, more than ever, maybe knowing what you own and why you own it, and as opposed to just owning a broad market? That's a question a lot of people ask us. So what's Dixon Mitchell's take on that?
Like sorry, just to be clear, Stephen, to be different than market or really knowing our companies? Is that what?
Really knowing your companies, because I think you mentioned earlier that in the past anybody could do well in a good market, but it's really now sort of in muddy waters that one needs to be cautious, but also really understand the balance sheets of companies.
Yeah, let me just phrase too. We did a lot of analysis on our competitors. One thing about this environment, I'll take us for example. We were being more defensive on the Canadian market. We bought companies, we sold companies like Canadian Tire, good business. Just we felt the consumer's over indebted. How much can it go? We added companies like Brookfield Asset Management, MTY Foods. So those are more resilient type businesses. So we're like, let's be more defensive. Then COVID happens. I look at MTY Foods. They're a company, basically they're franchisees. If you go to the malls, they own a whole bunch of restaurant chains like Ito Japan, Jugo Juice and whatnot. Well, their revenues went to 0 initially. So here we're being defensive, bought a good company, great management team with minimal debt. The CEO owned $200 million of the stock. He's aligned. The company collapsed. Now, to your point, Stephen, what happened is we didn't sell MTY Foods. We spoke to them, and the difference of having strong partnerships with these management teams is how candid they are with us because they know we're partners. So by having that relationship, our Canadian team could call the CEO and say what's happening. And thankfully we didn't sell the position. Now what's coming out is the government's coming out and they said to basically to the small stores, we're going to cover 75% of the wages, and they know they can survive now. So, but if we just owned a whole bunch of stocks, didn't know management, we would be guessing. Where a lot of the names we've owned, we can call them and find out what they're doing. And they just give us the intel and the assurance that the actions taken behind the scenes, that this company will survive and participate on the upside.
Okay, that makes sense. Thanks for that. I've got one other question.
Yes.
Some countries are experiencing negative interest rates around the world, and I'm just wondering if Dixon Mitchell sees this happening in Canada, and then what impact you see that having on not just the bond portfolios, but also financial sectors like insurance companies and banks.
Yeah, that's a good one. Obviously, insurance companies will be more impacted. Banks, as you know, they've got away from just traditional lending, where they've bought, obviously they've bought mutual fund companies. So will they be impacted? Yes. Will they be less impacted? Yes, because their business is more diversified. If that would occur, God forbid, I mean, for one, that would be positively impacting your bonds because rates are going down. But two, that would be negative on the equity front. And governments are going to do everything in their power to not have deflation. And I had this question before. Someone asked, are you guys worried about inflation? And I said, hey, let's just deal with today. Because remember, in 2008, with all that capital, we saw no inflation. And so I think we'll stay in a low rate environment. But yeah, we would have to, we only have Manulife in our portfolio insurance company. It will have a negative impact for sure. But the positive is your bonds will do well. But I think governments would do everything in their power to stop that from happening. I don't know if it's good or bad. We're in unprecedented times, but it would have a negative impact if there is deflation.
Okay, that makes sense. One other question, I think, being that we're in Alberta, and after listening to your presentation, you and Dixon Mitchell kind of exited out of the majority of the energy sector. You touched on that briefly, but where do you see that sector going from here? Like, do we really just need a pipeline, or do you think it's more than that, given that, we're kind of getting squeezed off here from the rest of the world?
Yeah, I mean, the pipeline, that's the big wild card. I mean, COVID's one thing, it's affecting all oil and gas companies. Obviously, Russia and Saudi Arabia, I mean, the timing of that, I won't get into it. I mean, that to me is inexcusable during this tough time. I think the big thing is, and I'm not an energy expert, Stephen, you probably know more in energy, but I do. But I think the wild card is the Trudeau government has to start, we need a pipeline. So we have all this oil. We have great companies like Suncor and CNQ, and it's just we got to get our oil to the markets and get fair market price, where we're not getting that, and that's why we've trimmed our position. And just to be clear, you may think, hey, we trimmed some oil names, but we have some energy names that we're exposed to, like Canadian Western Bank. If things improve, well, they're going to do well, and they're trading cheap. Badger, we have a whole bunch of companies that have indirect exposure, so you'll get that upside. But the wild card is getting a pipeline and reducing all the regulatory, red tape. Sure.
Okay. Well, I don't have any other questions at this time, but I wanted to thank you, Jim, for your time over the last 35 minutes or 40 minutes or so. It goes a long way to helping all of us understand what Dixon Mitchell is doing to navigate these choppy waters and obviously prepare us for what lies ahead. If anyone on this live feed did not have an opportunity to ask a question, we're certainly available, and we can make sure that your query gets answered. So please email your advisor, and we'll make sure that it gets handled right away. For everyone out there, please remain healthy and stay positive during these days and weeks ahead. And we appreciate you for joining us today. Goodbye, everybody.
Yeah, thanks again, Stephen. Appreciate it.
No problem.
Take care.
You too. Bye-bye.